Gold's a bad long-term investment, and here's why. Gold has had a hell of a run recently, up 8% in the last 3 weeks or so, which is nothing to sneeze at. I mean, in less than a month, 8% returns. That's really nice. And nearing $2,000 once again. Recently, intraday, it punched through $2,000, wasn't able to close above that level. But those are some historical highs, and it makes sense. There's geopolitical risk escalating, the Middle East, and how many countries and economies that war in the Middle East is going to include, and that's been causing a little bit of a fear bid. So why is it a bad investment? Well, fear a lot of times can be ephemeral. It can be short-lived. Which of course isn't meant to undermine anything that's going on in the Middle East, but historical wars between Israeli and neighboring parties have been a few weeks, few months, what have you. And of course, we hope it's as short as possible here. But also outside of geopolitical risks and war, some of these fear bids, as you can see in gold over the course of the last decade, have been relatively short-lived. You talk about the 2020 run-up on the pandemic. Gold gets above $2,000 for the first time in over a decade in recent history there for gold prices. And by the end of the year, it backs off. And then by, trading in 2021, came all the way back to $1,600, $1,700. You see another run up on inflation. Where will it stop? Inflation then does stop and turn around. Gold comes all the way back to $1,600, $1,700. We're seeing another recent run up to that $2,000 level, which, if you bought gold around its lows for the last 10 to 15 years, and let's say you bought it at the start of 2010, that's an 80% return, which, hey, Frank, that sounds like a great investment over the course of the last 13 odd years. But also, if you bought this market when it's been historically attractive, when this fear is entering the market, and you're seeing a fear bid, so to speak, not making so much money. I mean, this market did get up to 1900 plus prices in 2011. And if you bought at that time, you're only seeing, around a 4% return from that high, that previous high until now. As a lot of commodity markets tend to be mean reverting as opposed to stock markets that have historically tended to drift higher. And here comes that comparison for long-term investment. The S&P in that same time frame, if you bought at the start of 2010, is up 280%. And that same time where fear was entering the market and a gold would have yielded between 2011 and now a 4% return, S&P would have yielded you a 276% return. Now, of course, there are short-term setbacks, just as there are short-term run-ups in gold, which maybe makes it a better trade than an investment. We'll get to that in a second. But, historically speaking, the stock market has drifted higher. Of course, the caveat must be said that all of these markets can go wherever they want. But you're talking about historical returns here, not really any comparison to be made from gold to the stock market. And then, my friends, you start talking about if you can suss out the sector that's, really on the precipice of growth, the single stocks that might be the next great investment over the next decade or what have you, like Apple has been over the last 10 years or so. And I mean, at this point, you're talking about potential returns that are much higher than this gold market that's been essentially locked in a range of $1,000 to $2,000 over the last 10 years. Now, of course, finding the next Apple is one of the most difficult things in the market. And if I could find the next Apple, I probably wouldn't be here talking to you. But, that still goes for Microsoft and Google, many stocks up more than 1,000 percentage points since 2010 here. And again, kind of making the idea of investing in a commodity like gold not really comparable when it comes to long-term investment, especially when you compare it to some single stocks like Apple and Microsoft. And this doesn't make this market, oh, well, then gold should be completely taken off the board and it should go to dust. No, it serves its use for sure. And maybe even a more practical commodity like crude oil that obviously is used for automobiles, jets, and so many different practical endpoints. These are both commodity markets that are relatively mean reverting or relatively range bound historically. Here you have since 2010 gold in a price range of around $1,000 to $2,000, and crude oil. And even if you knocked out those crazy prices around the start of the pandemic, some of the only sub $30 a barrel prices that we've seen in recent history for crude. This is a market that trades from around 20, 30 bucks up to 100 or 120 bucks that we saw at the heights of the Russian-Ukrainian war. But a lot of time spent in between, which you can't really say for the stock market, as the S&P went from trading around 1,000 bucks to 2,000 bucks to 3,000 bucks to 4. It doesn't seem to trade between 2,000 and 3,000, historically speaking, that is. And so what does that make for gold here? Well, maybe not a good long-term investment, but can offer short-term value, especially when these fear bids are coming into the market or even coming out of the market from the short side of things. Plenty of trend followers and contrarians take a look at this market because, it can move up or down 10% in a given day, week, or month, which can't be said for the stock market at large. If we get an S&P move 1 or 2 or 3 percentage points, that's considered a big move. So plenty of use here for gold. Long-term investment, historically speaking, maybe not the best one.